I don't want to
All
take
right,
forever
so
on this, but just to make sure everybody totally understands, it could actually be a different low and high at each individual Forex bank because of the way the market works.
yes, that's absolutely that's a good thing to point out. You could be stopped out at one broker where, like, let's say, for example, you had the exact same trade going on at 3 different Forex brokers. It's possible for you to be stopped out at one and not the other, or, you know, 2 and not one of the others. So it's not the equal centralized playing field that the futures market is. Okay. Um, so my whole point is really currency futures are very simple, and calculating in currency futures are much more simple than they are in Forex. Again, the Canadian dollar is $10 per tick, and it's always going to be $10 per tick, no matter what happens to the Canadian dollar, which isn't the case in Forex, because in Forex, Canadian dollars are actually quoted in Canadian dollars, so you have to convert. But it's real easy. See, if the Canadian dollar drops 178 points, you made or lost 1780. No conversion, just simple math. It's real easy. And I like easy. Maybe, I don't know, maybe I'm lazy, I'm not sure, but simple is good, right? Okay, one thing to keep in mind, and again, I'm saying currency, Forex isn't all bad. There are some positive things in Forex, and sometimes, you know, clients might very well be better off having a currency futures account and maybe a Forex account so that they can kind of take advantage of the best of both worlds. But that's a personal choice. But anyway, the currency futures margin does tend to be a little higher than in Forex for overnight rates. So if you're a buy and hold trader, if you're buying a euro and you want to hang on to it for a couple days or a week or whatever it is, you're probably going to face slightly higher margin costs in the futures market than you do Forex. Now, keep in mind that Forex margin, like I mentioned before, changes really with every pip. The margin adjusts itself with every movement of the market. In Forex, it's pretty static. It doesn't change unless the CME changes it, and that really doesn't happen very often. I mean, maybe once a quarter, sometimes less, sometimes more. So this is all relative, but in general, you're probably going to pay more in the futures market to hold positions overnight. But I think we mentioned this briefly before. Futures traders are granted deep discount margin rates by their brokerage firm for day trading. So if you're in and out in the same session, you're going to pay a heck of a lot less in margin in a currency futures account than you would a Forex account. Now, this is a big deal if you're scalping. If you're only looking to make 1, 2, 3, maybe 10 ticks a trade, whatever it is, you probably are going to be much better off in the futures market because you can do it with much less margin. And again, I'm just going to remind you, I'm not saying that everybody should trade super high leverage and do that sort of thing, but it's nice to know that it's there. If you get into a little trouble intraday in a Forex account, you're going to run into more trouble with the margin managers than you would in a futures account. And we kind of touched upon this a little bit, but we're going to make sure you understand the truths and the myths about currency market liquidity. It's often said that Forex, and again, Forex, not currency futures, is the deepest and most liquid marketplace in the world. Approximately, and this 4 trillion, this was 6-8 months ago. Maybe it's a little different now, but just bear in mind the overall point. Approximately 4 trillion is traded in the Forex markets per day. Participants can be large banks, central banks, institutionals, hedge funds, and now individual retail traders just like us. But Forex trading liquidity claims are a bit misleading. Again, most of the daily volume occurs in foreign exchange swaps, which are rollovers. So I mentioned before, currency in the Forex rolls over every 2 days because every contract that you buy or sell is deliverable in 2 days. Now, as a Forex trader, you probably don't know it. When you buy a euro dollar in your platform, you really don't see anything going on behind the scenes, but your Forex broker is continuously rolling that over and rolling that over for you so that you don't take delivery of the currency. That is what makes up most of the daily volume in Forex. So does that really add to market liquidity? No, because it happens at the end of the day. I think it's 5 o'clock New York time, and that's that. So yes, is there tons of liquidity? Yes. Does it benefit you? Probably not. Also, we mentioned before, but I'll say it again, those that are trading with dealing desks aren't benefiting from the liquidity that brought them to Forex in the first place, because it's not a single market. It's hundreds of mini markets. And as Mike said before, there's a bunch of brokers out there. I mean, there's tons and tons of Forex brokers out there. Well, you can think of it this way. Each Forex broker represents an individual marketplace. So I've seen some really big Forex brokers, and I've seen some really small ones. In some cases, when you're trading with a very small firm, it's very possible that you're only trading with a handful of people. You're seeing quotes, and you think you're trading in a big market, but you're not. And somebody asked a question about liquidity earlier today, and I mentioned that on the CME they're trading somewhere around 200,000 euro futures contracts a day, and obviously that's not, I mean, it's a lot because each contract represents 100,000 worth of the underlying currency, and it is. That's a very liquid market. The bid-ask spreads that tick almost 24 hours a day. You're going to have no problems getting in and out. It's highly, highly liquid. But when you're talking about 4 trillion in Forex versus 200,000 contracts in the futures markets, on the surface people feel like it's far less liquid on the CME, and that's absolutely not the case. Liquidity is less about numbers and more about fill quality. And I would argue that your fill quality and the accountability, which is even more important, is better on the CME than it ever will be in Forex. All right, let's talk about the real transaction costs in currency trading, and we kind of touched on this as well. But before we get into much of that, let's kind of recognize that there's actually 2 ways that Forex brokers might generate revenue, and it depends on who you're trading with and what environment they're putting you in. And when I say environments, I mean who the liquidity partners are and so on and so forth. So the first way that they might generate revenue on your account is what's called, they call it a markup. And this is, again, Forex's, they're genius marketers because they know that people don't like to pay commission. So they didn't call it commission, they called it markup. That way people don't really understand what they're doing, right? And a markup is basically charged as a dollar amount per million units traded. A lot of brokers will charge $10 per million, which is approximately like $10 for a standard contract, or $1 for a mini is kind of how it works out. And a lot of you, if you are trading retail Forex accounts, you've probably maybe even never run into markup or this type of traditional commission being charged in a Forex account, and that's because it's only available on ECN networks, and ECN network is basically the quote-unquote real Forex market that I mentioned before, that's made up of several banks and institutions and things like that. Most retail traders have a hard time getting access to the ECN market, although it's a much truer marketplace. And the reason they have a hard time getting access is most brokers won't even give you that option unless you're trading 100,000 or more. Some of you might be familiar with PFG, who unfortunately was caught up in a big fraudulent scandal about 1.5 years ago. But they were one of the few Forex brokers that did offer ECN network trading to even the smaller clients. And knowing now what we know about PFG, now it's easier to understand why they were able to do that when nobody else could, because they weren't necessarily operating in for profit margin. If you know the story, then you know what I'm talking about. Anyway, most Forex trading accounts generate revenue for the brokerage firm based on the pip spread. It's a hidden commission. So when you hear people talk about commission-free trading, it's totally bogus. It's all marketing. But they are paying to trade. Like I had mentioned a little earlier before, the brokerage firm will accept your trade and they'll execute it. So if you're buying the euro, they'll sell it to you, leaving you, so you're long, and then they will turn around and buy it in the interbank market, which is a bigger, truer market with tighter spreads. And that way they don't have any trade risk, but when you offset, they'll offset their position in the interbank market. And in the end, they come out ahead because they charged you 3 pips and they might have only paid a half a pip or whatever the difference is. So if they tell you you're paying no commission, don't believe them. You are paying commission, and especially if they tell you they'll give you a rebate, that means they're making too much money on you in the first place, and they're giving you a little back.
A couple questions are up.
A lot
right
of
now.
people assume that.
Sorry.
Yep, sure.
Stephen is asking, what's the reason for requotes on the FX market?
Really, requote, like, I know that if you're trading options, you can request for quote, and that's really because there's nobody else trading it. As far as the actual Forex contracts go, if you're requoting, a lot of times that'll happen in a fast market. You know, I don't know what the true issue is. Sometimes the Forex brokers' systems can't keep up with the fast market, you know, of the interbank market, things like that. Because you have to keep in mind, your Forex broker is basically showing you a synthetic market, is a good way to put it. Like, they're taking quotes from the interbank market, which I'm calling the real market just for lack of a better word, and they're using that to create a synthetic or a fake market for their clients. And sometimes, you know, if there's real, like, for example, non-farm payroll report or something like that, there's just, the trade just can't keep up. And so sometimes you get requotes where brokers, you know, I haven't really run into it, luckily, that often, but, you know, it is possible for brokers to requote, and I've heard of, you know, fills being changed and things like that, but unfortunately I haven't had much experience with it. So
last question. Arbach is asking if there is any type of like high frequency, low latency arbitrage between the CME and spot Forex markets.
I'm sure that there's some genius out there that's figured out how to do that, so I'm sure it exists. It's not, I'm not something that I've ever been privy to.
Yeah,
so
I think it's safe to assume.
I wouldn't know much about it. I would guess that it would be.
Yeah, I mean, if you throw up a chart of a big bank, a big spot Forex bank, and then throw up a currency, a futures currency chart, you know, on the CME, they will generally move in lockstep. You know, one goes up one tick, one goes down one tick. So there's definitely somebody there doing a little bit of arbitrage.
I would have to agree with that, yes. Is it me? No. Or anybody I know? Or do I know how to have access to that? No, but I am sure it is done. You know, there's a lot of smart computer programmers out there. So. Okay, is that all the questions?
And that's it for now.
Okay, for now. Okay. Alrighty. So don't assume that transaction costs are lower in the Forex market relative to the futures market, because they aren't. And in fact, you might actually be paying more in Forex than you would in futures. It really depends on your deal with your futures broker and things like that. But I would venture to say that it's comparable, or maybe even in some cases cheaper in the futures market, depending on what your rate is. Because if you think about it, if you're paying a 3-pip spread in the currency market, it's approximately $30. If you're trading in the futures market, you're probably paying less than $30 in commission if you're trading the outright futures and you're doing it online. So, you know, again, there's a lot of ifs and a lot of room for differences here, but I would assume that it's probably even a little cheaper in futures than it is a lot of Forex arrangements. And I'll say it one more time, the Forex market, or the Forex industry, they were very smart and very good at marketing, because free commission really is the best way to get people to overtrade. And as a brokerage firm, it's unfortunate, but a lot of brokerage firms believe that they want their clients trading as much as possible, and and that's how they want to make their money. They're not, in other words, they're not looking at the big picture in the long term. Unfortunately, a lot of brokerage firms want commission today, and that means, you know, their clients churning their own accounts, which it's, you know, it's very disappointing, because we all know that if you're over trading, you're probably not going to last very long. You're probably going to blow out your account eventually, maybe in a day, maybe in a week, or maybe in a month, but it's not a long-term proposition. Okay, we'll brush upon futures margin versus Forex margin. We've already kind of discussed this. One thing to really be aware of is the Forex margin is dictated by regulators, or at least it is here in the U.S. If you're overseas, it's a whole different story. There really isn't anybody telling brokerage firms what to do. Here in the U.S., we have the NFA and the CFTC are just now, I mean, in the beginning of Forex, they really had no say whatsoever in what happened in the Forex markets. But at this time, they are getting a handle on things, and they actually limit the amount of leverage that Forex brokers can provide to U.S. clients. The current leverage ratio is 50 to 1. So futures brokers in the U.S. cannot offer more than 50 to 1 leverage. And as we mentioned before, Forex margin, if the dollar is the base currency in Forex, or you're trading cross pairs, margin must be converted back to the home currency, so it's a little more complicated. And another thing to know about Forex is the margin is actually measured and assessed around the clock. Margin calls are instantaneous. This is a lot different than in futures. In futures, margin's only really measured once a day, but in Forex, it's 24 hours a day. So for example, if your account dips below the margin level in the middle of the night, you immediately are on a margin call. If it dips below and bounces back, you know, good for you, but you still probably had somebody give you a call or send you an email and you know, kind of bust your chops about it. In futures, like I said, it's a little bit different. If you dip into what would maybe be a margin call intraday in futures, but a market bounces back, you're not going to hear from anybody. It happens all the time. And in Forex, like we said before, there's no break for day traders. The margin is the margin whether you're holding for 1 second or 1 month or 1 year. The futures margin is static. It rarely changes. It's levied by the exchange, so regulators don't tell the exchanges or the brokers how much to charge their clients in margin. The exchanges set the margins, and it's measured once a day at the close. If you're trading the CME currencies, or actually even ICE, I believe is about the same, they close at 2 o'clock Central Time. No, I take it back. 4 o'clock Central Time. It's 2 o'clock my time, but 4 o'clock Central Time. So at that point of the day, the exchanges take a look at all the accounts, determine who's on or off margin call, and that's it. So what you do between then, well, I should say the market, it's kind of confusing, because the futures market opens up in the afternoon and then it trades all the way around the clock to the next afternoon. So it's basically open 23 hours a day, just in a nutshell. What you do during that 23 hours a day is really between you and your brokerage firm. The exchange really only dictates what happens when they measure the margin at the close. So just remember, if you're trading futures, your broker sets the day trading margin, but the exchange sets the overnight margin. If you're trading Forex, regulators set it, or regulators tell your broker how to set it anyway. And I don't want to be too repetitive, because we've kind of answered this already, but there's really 2 types of margin in the futures market. There's the overnight rate and then the day trading rate. The overnight rate consists of the initial and the maintenance margin requirements, which really only apply to traders that are holding positions overnight. And again, it's typically higher than FX. And some of you might be wondering what initial and maintenance are, and most of you probably already know. Initial margin is basically what you need to have in your account to put the trade on, and maintenance is what you need to have in your account to avoid a margin call once you have the trade on. Day trading margin rates are a little bit different. Futures day traders are often granted very low margin rates for positions, but that doesn't mean that you should use it. The odds of success are greatly diminished when leverage is abused. Now, I know a lot of brokerage firms out there that they offer $300 or $400 margins on the CME currencies, but what they won't tell you is, and I'm not saying any brokerage firm is good or bad. I'm just saying know what you're getting into and do your homework before you open an account. A lot of the firms that do advertise the super deep discount day trading margin rates, they'll let you into the trade with a very small amount of money on margin, but if you, for a split second, dip below their margin levels, their day trading margin levels, they'll just go ahead and blow your position out. They won't ask you, they won't email you or call you. They just say, whoop, he went over slightly, boom, he's gone. Or another thing they'll do is they'll tell you they only charge, whatever it is, $500 on a day trading rate for a certain market, whatever that market is. But then they'll say, but to open an account, you have to start with $30,000. So just be aware of the little marketing gimmicks and just know that some of these things that they're trying to sell you on are not in your best interest.